Okay, good morning, everyone. Welcome to this joint European Association of Corporate Treasurers and Loan Market Association webinar on Libor transition. I'm just letting all participants in, so bear with me for a couple of seconds more. And can I ask you to check that you can unmute yourself? Yes.
Can you hear me? Yeah.
Yes. So you will have noticed that I've muted everyone as they came in. I think we can start now and people can still trickle in as we come along. So welcome everyone and good morning to this webinar on Libor transition. A few just very brief housekeeping points at the beginning. So you will have all been muted already and there will be an opportunity to ask some questions. You can click on a button at the top of your screen that says show conversation, where you will then be directed to a chat box where you can type in your questions if you'd like. Cam will give us a presentation on where we are in terms of Libor transition and what the latest initiatives and developments are. And I will briefly cover some of the regulatory developments at the EU side. And then we'll open it up for questions. So this should be, so we should be ready to wrap up by 11 o'clock European time. So maybe without much further ado, I'll hand over to Cam Mahil, Senior Director at the Loan Market Association. And I'll also start sharing from my screen her presentation.
Great. Thank you, Tarek, for the introduction and also for inviting me to present on this topic. And hello to everyone watching. So for those of you who don't know me, as Tarek said, I'm Cam Mahil and I work for the Loan Market Association. Those not so familiar with the LMA, we're the trade association for the syndicated loan market in Europe, Middle East and Africa. So we need to have quite a global perspective on the transition. I've been working on Libor transition ever since July 2017, and I also personally sit on many of the currency working groups. So I sit on the Euro working group, the Swiss working group, and also the Sterling working group, and also attend some of the EACT loan meetings. So I know this topic very well, and a lot has been happening on reference rate reform during the year, and time is starting to run out for Libor transition. We have a Libor transition countdown clock on our website, and I checked this morning and it's 414 days to go until the end of 2021. So turning to the next slide where we've got the agenda for today, I'm going to talk through developments by key topic areas that you should be aware of, and I'll contrast what's happening in the different IBOR jurisdictions. I'll give you an overall picture of where we are, some of the key timelines, and then I'll focus in on some of the key topics like what's happening with forward-looking term rates, with calculation of compounded rates, adjustment spreads, documentation and legacy, and then I'll finish off with some practical steps that you could be taking and some key messages. So turning to the next slide, we'll look at the bigger picture on where we are with transition. And actually, Tarek, if you click on to the next one, great, thank you. So in terms of where we are globally, the regulators, including the FSB, the FCA, and the ECB have all reiterated the need to transition away from Libor in a timely fashion, and that the headline date remains the end of 2021, and that's despite the market disruption that's been caused by COVID-19. Now, COVID did lead to a delay in some of the interim milestones, but it's not led to a delay in the overall end of 2021 milestone. In fact, the view of the regulators is that the impact of COVID shows why the transition is so important. So Andrew Bailey, who's now governor of the Bank of England, he gave a speech called Entering the Endgame. And he said, as an example, that in the week of 16th of March this year, over half of the 35 published Libor rates had no transaction-based submissions. So they were completely based on expert judgment. By contrast, transactions underpinning the RFRs are on the rise. And so the key message is don't expect an extension of the timeline. Now, the regulators did acknowledge that COVID understandable impact in terms of bringing end users up to speed on the transition, because obviously corporate focus has been elsewhere, has been on their business and in some cases on survival. But the regulators have now asked for education efforts to start increasing from September onwards, given the impending deadlines. I'll take you through the timelines on the next slide, but just to say that there's an increasing focus on the need to tackle the legacy book, and there have been some announcements made around so-called tough legacy contracts, which I'll cover later. In terms of other key developments, recommended conventions for loans have now been announced in the US by the Swiss market and also the sterling market, and that was a very important milestone that market participants were waiting for. And in some further good news, we actually did see some beta or prototype versions of forward-looking term rates being produced in the sterling market for SONIA. They're not yet available for use, but it is still a key development because it means that parties can actually start observing the behaviour of those rates. And there's also been some work happening on US dollar and euro term rates as well, which I'll come on to later. So moving to the next slide. Whilst we have the end of 2021 date, that doesn't actually give you the whole picture on what's happening, because there are various interim milestones that mean there'll be an acceleration in the pace of transition. So there are milestones in particular around the offering of non-LIBOR based products and when LIBOR lending should actually cease. And all of those are before the end of next year. So in the Swiss market, FINMA issued a Dear CEO letter earlier this year, which stated an expectation for proactive action to be taken now towards issuing new products and contracts based on the RFRs. In sterling, by the end of Q3 this year, lenders were required to be in a position to offer non-LIBOR linked products to their customers. And by the end of Q1 next year, there should be no more sterling LIBOR loan issuance. For US dollars, the ARC has set a target date of no new US dollar LIBOR loans from the end of June next year. Now, in the euro area, we haven't seen similar timelines because Euribor is set to continue. However, the ECB did recently publish an assessment of readiness for benchmark rate reform, which concluded that further action was needed. A point to flag just about this timeline is that I focused in on the LIBOR currency jurisdictions, but just be aware that there are some other jurisdictions which are laying down timelines. So, for example, Hong Kong and Singapore. So do just check what the local regulator is saying in any of the currency jurisdictions that are relevant to you. And also the FSB has recently published a global transition roadmap, and they've also set out some transition milestones, including that by the end of this year, firms should be in a position to offer non-LIBOR linked loans to their customers, and they can do that either by giving borrowers a choice in terms of the reference rate or through including conversion language. So the main point on this slide is really that parties can't just assume that they have until the end of next year to be ready to either borrow or lend based on the RFRs instead of LIBOR. So moving to the next slide, which is rather a busy one, apologies, but it does set out some other important milestones from now until the end of 2021. So I think the main focus at the moment in the LIBOR jurisdictions is on the implementation of the operational capability for RFRs, and that includes market participants taking steps to implement system changes within their own internal systems, which we know can actually take some time. I mentioned that the end of Q3 represented some key milestones. So from that date, the ARC has recommended the inclusion of hardwired fallback language in US dollar LIBOR syndicated loans. And the Sterling Working Group has also recommended the inclusion in new and refinanced sterling LIBOR loans of clear contractual arrangements to facilitate conversion to alternative rates. I'll touch more later, but it's just a flag because you will probably start seeing changes in contractual language coming your way. We also had the release of the ISDA protocol and the definitions for derivatives, which are to take effect on the 25th of January. We're expecting the Euro Working Group to publish their consultation on Euribor fallbacks imminently, which will cover appropriate fallback rates and also fallback triggers. And the final recommendations are expected in February next year. On term rates, I'll cover those later, but just to flag on the US dollar side, it's not expected to be available until halfway through next year at the earliest. The other milestones just to draw your attention to on this slide are ones around reducing the legacy stock of Libor cash products. So in the Swiss market, FINMA is expecting a substantial reduction in Swiss franc Libor cash products and also the introduction of robust fallbacks by the end of this year. In the sterling market, reduction of sterling Libor legacy contracts needs to be accelerated by the end of Q1 next year and then completed by the end of Q2 or Q3 next year where viable. The other thing just to remember is that obviously we have Libor transition, but there's also the transition from EONIA to Euro STR to think about because EONIA is being discontinued on the 3rd of January 2022. So those are various of the key milestones as they stand, and as you can see, there is a lot that's happening. So moving on to the next slide, and actually we'll move on to the next slide. We'll talk through some of the key transition issues. So as I say, I'll look at what's happening with forward-looking term rates, conventions for using RFRs, and particularly in loans and how that compares with derivatives, spread adjustments for legacy deals when transitioning from IBORs to the RFRs, documentation and legacy issues. Obviously, underpinning all of that are the necessary systems updates to deal with these new rates from both the bank side and the borrower side, and also the question of how to deal with multi-currency transactions. So moving to the next slide and forward-looking term rates. So as I mentioned, these are still not available yet. They're not expected to be available until the end of this year at the earliest for sterling, and the middle of next year for other currencies. The use cases for the term rates are also expected to be limited. So the Swiss are not looking to create a forward-looking term rate because of the lack of liquidity in the Saron derivatives market. We know that Euribor and Tibor will continue for the foreseeable future. However, the Euro Working Group and the Japanese Working Group are working on producing RFR term rates. Now, in terms of progress, I mentioned that the sterling market is the most advanced. We've got 3 potential administrators who are looking to produce a SONIA term rate, and all of them are now publishing beta rates. So it's ICE, Refinitiv and FTSE Russell are the ones that are producing the beta rates. And there'll be a test period for which these rates will be produced, and then the FCA will make an assessment about whether they can be used in transactions or not. Now, it's worth mentioning that the publication of those beta rates was actually delayed due to COVID because there was disruption caused to live streaming of quotes on electronic order books. And that's actually raised some question marks globally about the robustness of forward-looking term rates based on RFRs in times of stress. But I think on that, time will really tell. It's also worth noting that the Sterling Working Group is not planning to actually select one of the administrators, so they're just going to let the market decide. I mentioned that use cases are being limited, so the Sterling Working Group published a use case paper which identified certain sectors of the market, such as export finance, trade finance, emerging markets, as well as certain smaller users that may need forward-looking term rates. Other options were all paper as to compare, so fixed rates and Bank of England base rate. In the US, I mentioned that the EACT plans to have a SOFR term rate available in the first half of next year. That's dependent on liquidity in the SOFR derivatives market having developed sufficiently. They recently closed an RFP process for an administrator, and we are expecting the EACT to publish some details around scopes of use for such a term rate. It is worth noting that the EACT recommended hardwired fallback language for corporate products does include the term SOFR rate as the first step in the waterfall. In terms of the euro, we had 4 administrators present to the Euro Working Group. One has since dropped out, but the rest are positive about their ability to produce a term rate in due course. Now, the Euro Working Group is also looking at use cases for term rates, and that work is expected to be published in the coming weeks for consultation. So do keep an eye out for that, and do respond either yourselves or obviously via the EACT or via your local ACT. A general point to note on availability of term rates is that they will depend on the liquidity in the derivatives market. And that's particularly important for the US dollar and the euro rate, because those are actually relatively new rates, and increased liquidity is expected to depend on the switch to CCP discounting rates. Sterling has been ahead because SONIA is actually not a new rate, so there was a pre-existing derivatives market. So I think given all of this, the regulators have remained clear that forward-looking RFR term rates shouldn't be relied on as just the sole solution to Libor transition. So there's still a focus on compounded RFRs. So if we move to the next slide, in the derivatives market and also the bond market, we have seen a very clear direction of travel to compounded in arrears rates. And this is also being used in some transactions in the loan market. So compounding in arrears is very different from using a forward-looking term rate. And I've tried to illustrate that visually on this slide. So with a forward-looking term rate, you know the interest rate and the payment amount at the start of the interest period. However, with a backward compounded rate, you would need to take the daily rates over the interest period. So that's represented by the little blue diamonds in the arrow at the bottom. And so you would not know your interest payment until the end of the interest period. So in order to try and build in some visibility of the interest payment, what the bond and the loan markets have been doing is using the concept of a 5-day look back. So you have at least a few days worth of certainty of what your rate is. So what you do is you start the observation period 5 days early, so that's T minus 5 on the slide, and then you end it 5 days early, so T plus 85. And you can see that by doing that, the interest period and the observation period are not entirely aligned, although they do largely overlap. Now, just to note, in the derivatives market, they are using a 2-day look back in their protocol and definitions. But we do understand, having spoken to ISDA, that they are working on new rate options to facilitate the use of RFR with certain conventions, and particularly those that are being seen in the loan and bond market. So this 5-day look back. So the look back period, I think, is a useful construct, and it might work well for some borrowers. However, a look back longer than 5 days may be needed in some cases if you're thinking about practical preparations, for example, budgetary approvals or sign-offs, especially if you're doing anything in developing markets. So turning to the next slide and conventions for loans. So there's been a huge amount of discussion this year on how you can make compounded in arrears work for loans, particularly because you can have prepayments and more on the bank side, secondary trading in the middle of an interest period. And the good news is that there has actually been considerable progress on this, and some key jurisdictions have published guidance on the conventions. So in the US, the EACT released conventions on SOFR in arrears back in July. Those cover simple SOFR and daily compounded SOFR in arrears. And the EACT did actually publish some supporting papers, which has got additional details about calculations. In the UK, we had the Sterling Conventions published in September, and that focuses on compounded in arrears. Again, they come with supporting papers and calculations as well, including a spreadsheet. The Swiss National Working Group also published its conventions this year back in May, although they did actually update them in September following the publication of the US dollar and sterling conventions. So we now actually have clarity, at least in 3 jurisdictions, but in terms of the Euro Working Group will deal with conventions in the upcoming consultation that's coming out. It's worth saying that the recommendations do vary in terms of the detail that they go into, to a certain extent in consistency, but they have been really helpful in the market in terms of providing some level setting. Another point just to say is that the conventions are, of course, voluntary, and they are not prescriptive, particularly on some of the basic concepts of compounding. So there's discussion in the market about whether you compound the rate or you compound the balance or you use a cumulative or non-cumulative calculation. I should say that compounding the rate seems to be generally preferred, and where things are moving to in the syndicated loan market is a non-cumulative calculation. I think also just to say, it's great that we've had these conventions publications, but one thing that's still to play out is how these conventions actually work in multi-currency facilities. So, for example, will people prefer to use one convention across all currencies, or will people prefer to use the individual currency recommendations, even when they are different in one loan agreement? So just moving to the next slide, I've tried to summarise where all of the industry working groups have got to on their conventions, and so you can more easily see how they compare and also how they compare to the derivatives recommendations. So you see for sterling there's compounded in arrears, a 5-day look back, no observation shift, although look back with a shift is accepted as a viable option. Now, the concept of an observation shift is quite a technical point, but essentially it's all to do with the weighting of the relevant rates. So if you use the observation shift, it means that you take the rate and you take the weighting of that rate from the earlier observation period instead of taking the weighting from the interest period. So as I say, it's quite a technical point, but it's just an important point to be aware of because it does have some knock-on implications. I did write a section about this for the Euro working group paper that's due to come out, and there is an example in there so you can get your head around that. So do read that. And then on the floor side, to the extent there is a floor, daily floors are recommended because a daily calculation is envisaged. So in the US, as I said, they've gone for simple daily or compounded in arrears. No specific look back period is specified, but also look back with no observation shift in the daily floor. I mentioned the Swiss changed their conventions just to align a little bit with what's happening elsewhere. So again, you can see some optionality that's been put in. And obviously conventions for Euro are still to be determined, which is why they're not on this slide. And then just a word about the derivatives market. So the ISDA approach is, of course, compounded in arrears, but with a 2-day look back and observation shift. So there is a question there about whether to use observation shift to align with derivatives, and also the question about multi-currency facilities. If we move to the next slide, I've tried to set out some of the recent deals that we've seen taking place, especially in the London market, because it's interesting to see what conventions are being used on actual deals. So we've recently seen a Tesco syndicated loan, and we've seen GSK enter into some bilateral loans based on compounded SONIA and SOFA. They did not use an observation shift, which is in line with the convention's recommendations. But I think it's really interesting to note that before the summer, we saw 3 syndicated deals in the market, and they actually all used observation shift. And incidentally, I'm hearing in the market that some borrowers prefer to use the observation shift going forward, despite the recommendations, because it actually helps them align with their derivatives and also their bonds. So I think it's going to be really interesting to see where the market goes on this, because I think it's too early to tell, what the settled position is going to be in terms of actual deals. I think a couple of other points to flag for you on this slide. I've highlighted some of the deals in dark grey, and that's because they are switch deals. So they start life as a Libor loan and then they switch at an agreed date to compounded RFRs, whereas the others were based on RFRs from the beginning. Interestingly, BAT and Tesco had Euro loans within their facility and they continued to use Euribor. The other point just to draw to your attention is that you will see that for many of these deals, the interest periods which the borrower can select are limited to one period only. So the flexibility to choose 1, 3, 6 months rates is not there on those deals, except for the Tesco one. And that's because there's been a discussion on some deals to limit flexibility to deal with break cost issues. So instead of charging a prepayment fee, the interest periods are limited and also the frequency of prepayments. And I think that's just something for borrowers to be aware of. And as you can see, Tesco pushed back on this trend and got multiple interest periods because that's what they wanted and that's what they actually needed for their business. So I think it's just something to be aware of. The final point to note is this isn't reflective of all the deals that are taking place, and I do actually maintain a public list of RFR referencing loans on our website. It is free to access. I think it's also useful to have a look at, and I'll send a link to Tarek after this session, but there's also a couple of video interviews that I've done with some borrowers. So I've spoken to BAT and GSK about their deals. I'll also be doing an interview with Tesco about their deal, and there's a written interview with Shell being made available. So I think it'll be really interesting, if you're interested in hearing from your peers and other treasurers that have gone through this experience and what they have to say about their reasons for doing what they did. So just moving on to the next slide. I just wanted to cover off publication of the compounded RFRs because there has been a broad recognition that borrowers and other users need to be able to check the compounded rates that are being presented to them without having to do the entire compounded calculation themselves. So, for example, if you take an interest period of 3 months, well, that would require 90 days worth of individual inputs if you had to do it manually or on a spreadsheet. And I think there's also been a recognition that there needs to be a trusted, free-to-use golden source for end users. So because of that, various of the RFR administrators have come out with proposals about producing compounded RFR period averages, but also compounded indices. So period averages are being produced by the Fed and SIX for SOFR and SARON respectively. The ECB recently consulted on this. They published a summary of the results last month, and respondents seem to be in favour of the ECB publishing this, although the ECB hasn't yet made a statement about what exactly it plans to do. The Bank of England is not going to produce these because it received feedback to its own consultation that it didn't have enough support for these. So just to say that period averages, they show the rate compounded over a specified period. So 1 month, 3 months, 30 days, 90 days, depending on the actual administrator. And as a result, they're probably more helpful when you're setting the rate in advance, because particularly for loans, you need the ability to calculate as you go along. So that's why the administrators have also been looking at indices, and the Fed, the Bank of England and SIX are all already publishing them, and the ECB also consulted on this, and the summary of the feedback seems positive in favour of the ECB doing this, which is good to see. But effectively, the index allows you to calculate a compounded rate over a particular period. So all you do is you take the value of the start date, and then you take the value at the end date, and then you plug it into a formula. The reason I mentioned observation shift earlier is because the published indices are based on an observation shift. So they are more relevant for products where you are using an observation shift. Even if you do have a loan which uses an observation shift, there have been a few practical issues identified in using indices with more structured loans, so loans where you have a daily floor. But I still think it could be a useful tool for loans, but also other products, for example, bonds, including an observation shift. Now, given where we are, there's also been discussions in the market about whether a compounding calculator would be helpful. So, for example, NatWest has produced one on its website, and Raiffeisen has done the same in Switzerland. I think the key there will be finding a free-to-use, trusted, independent source, and we're not sort of quite there yet. So I think transparency for end users of the compounded calculation, yes, there's been some great progress, but I think there's still a little bit of work to do. So moving to the next slide, and just to cover off what's happening on the credit adjustment spread, we have clarity now for sterling and US dollars in the cash markets in terms of what credit adjustment spread do you use for fallbacks in cash products, where those are triggered by the cessation of Libor or a non-representativeness declaration. So effectively, it's just ended up in the same place as ISDA, so use of the ISDA historic 5-year median. There is still some work to do on who exactly is going to publish that spread for the cash markets, because Bloomberg has been appointed for ISDA and derivatives, but it's not been appointed for the cash market. So there's a little bit of work to do there. I also just wanted to draw your attention to the fact that Bloomberg is obviously publishing the ISDA spread at the moment on an indicative basis, and that's actually publicly available on a 1-2 delayed basis on its website. And I think it's really interesting to look at that data, because you can see where the spread levels are at the moment, and you can see that they're actually quite relatively static over the time they're producing it. But I would recommend that you check out the Bloomberg website, and I can send Tarek the link for the precise page that you can access that. The Euro Working Group hasn't consulted yet, but that is going to be dealt with in the consultation, which will hopefully come out in the next week or so. It's also worth just noting that there is some discussion in the market, particularly in sterling and US dollar markets, about how you calculate if you are transitioning early, so before a cessation or a pre-cessation event. There haven't been any recommendations on this from the Sterling Working Group, but we have seen a couple of approaches that have been used on actual deals. So we've seen a forward approach, and we've seen the ISDA historic median approach. And interestingly, the way that they've dealt with it on some of the recent syndicated loans is they actually fix the spread at the start. So they use the ISDA historic median, but they actually fix it at the date of the loan agreement. And having spoken to some borrowers, I think they felt that, well, it's actually a relatively static number because you're looking at a 5-year median, so they don't expect it to change very much. But again, I think people need to sort of take a look at these spreads, because there is an economic difference between using the forward approach and using the historic median approach at the moment. They are expected to converge the closer that you get to an actual trigger event, but they are different at the moment. So it's, again, something to just be aware of. So if we move to the next slide, I just wanted to cover off the fact that in the sterling and the US dollar markets, there have been some documentary recommendations in place from the start of October. And that, I think, will actually lead to a change in international loan documentation compared to what we have seen previously. And I have seen this approach start to permeate into other jurisdictions. So I know of a loan, for example, in Scandinavia, which has adopted the sterling approach. So it's something to be aware of. So in the sterling market, lenders working with their borrowers are required to now include clear contractual arrangements in new sterling Libor loans to facilitate the conversion of those loans to alternative rates. That can be done through pre-agreed conversion terms or an agreed process for renegotiation. Now, the pre-agreed conversion terms are the gold standard, according to the authorities over here. And what they basically mean by pre-agreed conversion terms are switch facilities. So a Libor facility with an inbuilt switch mechanism to RFRs at a set date. And that's actually quite a neat way of dealing with any systems issue. So if you're not operationally ready yet to move to RFRs, but you do actually know what you want to move to, you can set out all the terms and then put in a date for the switch in your facility. On the agreed process for renegotiation, the working group was clear that that meant something more than just the 2019 version of the LMA replacement of screen rate clause. So we have had to issue some updates to that clause to make it compliant. And then just to contrast with what's happening in the US, so new US dollar LIBOR loans need to include hardwired fallback language. And the EACT language includes a waterfall of rates to fall back to, so forward-looking term rates being the first step, followed by either simple SOFR or compounded SOFR. It's worth noting that the EACT language gives a lot of discretion to the agent to unilaterally make conforming changes, and that's without borrower consent. And that includes commercial changes like break costs and what interest periods are available to the borrower. Now, that might be fine in the US, but it's certainly not in line with accepted agent discretion that we see in EMEA. And I also don't think it's that great for the borrower either. And that's where the switch mechanism goes so much further than the EACT language, because the switch actually sets out all of the terms around the use of the RFR. So the agent doesn't need to take on as much discretion to make conforming changes because you've agreed everything up front in the document. So just moving to the next slide and just to flag some of the work we've done. So I mentioned that we updated the replacement of screen rate clause in light of the Sterling Working Group recommendations. So we've enhanced that to include some set trigger dates for negotiations and also to include a placeholder for any pre-agreed conversion terms. And we've also published language for pre-cessation triggers to allow people to align their loans with their hedges. We also published in September an exposure draft rate switch facility agreement, and we've incorporated the sterling loan conventions into that and also the formulae. So we're going to be publishing an updated version, and actually we're releasing two versions, so one based on observation shift and one based not on observation shift, so that the market can choose whichever one it prefers. We're also going to be producing a multi-currency RFR facility, so one that's based on RFRs from the very beginning, and also looking at the broader suite of documentation. Just to flag on the legacy side, we did publish an exposure draft reference rate selection agreement, which is designed more for larger syndicates to get the requisite consent to all the changes up front. So that you then can delegate authority to the agent and the borrower to go off and actually agree all the other little changes that need to be made. It is a two-stage process, so I would say it's not something that's particularly suitable for bilateral or club deals, where I think a one-step process makes more sense. But I think in this case, what will be key when looking at legacy transition is understanding, well, what does the new agreement that I'm moving to look like? And so I think in that respect, the draft facility agreements that we're producing for use are actually helpful and a key focus, because you can then see what are the changes that I actually need to make to my facility agreement to deal with RFRs. So moving to the next slide. So I would say that the clear message from regulators is that the focus really should remain on active transition rather than relying on legislative solutions. The quote at the top is from Andrew Bailey's Entering the Endgame speech, which the Fed also spoke at. And effectively, they were saying that taking an active approach to transition is the only way to control the terms on which transition takes place, rather than having a solution that's imposed on you. Now, how you transition legacy agreements depends on the product in question. So for derivatives, we have the ISDA protocol method that allows you to change multiple contracts, provided your counterparties also sign that protocol. Now, that is a really useful tool, but I think just on the borrower perspective, just be very careful about using the protocol where you've got derivatives that hedge an underlying cash product, because it might not be appropriate to apply the protocol to that hedge if the underlying product either can't be moved or it's moving to a different rate, and that could cause basis risk. So, for example, if you're in a category where you can use a forward-looking term rate, but obviously the ISDA protocol is saying the hedge will move to compounded in arrears, well, then there's a mismatch. So, just be careful about watching out for that. What I would say on that is that ISDA has actually published some bilateral templates. So you can actually use those to adopt the protocol bilaterally, and you can make amendments to the protocol, or you can actually use those bilateral agreements to exclude certain transactions from the effect of the protocol. So it's quite a neat way of making sure that you can align your triggers and fallbacks in your underlying contract and your hedge. Now, for loans, you can't use a protocol because, unfortunately, they're not as standardised as the ISDA contracts, but also you often have multiple counterparties, whereas hedges are bilateral. So those do require individual amendment and the necessary consent. I've actually included a reference on the slide to a paper that I drafted for the Sterling Working Group on active transition of legacy loans. And that sets out the steps that parties need to take to transition their loan and steps that you need to consider. It's high level, but I think it's useful in terms of setting out the things that you need to think about when transitioning. And you can use it when approaching your lenders to start a discussion about legacy transactions. Now, of course, it's based with sterling in mind, but actually the points in it are generally applicable to loans. So it's worth taking a look at. And again, I can send a link to Tarek for sending on. Just a brief word about tough legacy, because Tarek mentioned he's going to cover the EU legislative proposals. But effectively, there have been several legislative proposals that are now out there in different jurisdictions to deal with tough legacy, and they are a bit different to each other in terms of how they operate. So I'll just flag on the UK side that there is the financial services. That's intended to give the FCA the power to direct a change in the methodology of Libor where it's no longer representative. Now, that raises a number of questions, including, well, what methodology is Libor going to change to? Which Libor currencies does it apply to? How far is the extraterritorial effect, because it's going to be changing the underlying screen rate? Now, any modified rate would only be available where there has been a non-representativeness declaration. So to the extent that you have a non-representativeness trigger in your agreement, then the legislation is likely not going to be relevant to you. Now, the FCA is also going to limit the contracts which can use the modified rate, and we don't know what those limitations will be, but of course it raises then questions of, well, what happens if they decide that derivatives are out of scope, but the underlying cash products are within scope? So again, it's something that we've been talking to the regulators about. As I said, Tarek's going to cover the EU proposals, but again, there are question marks around those proposals too, including territorial scope and how they affect different products. So many questions and concerns being raised in the market about these proposals, how they interact. So I think, look, these initiatives have very positive aims, and I think it's very helpful that the regulators are coming out with these proposals. But I do think they need a bit more thought, and there's no easy answer. And that's why the focus should be on active transition, just so you can be very clear about, where you're moving to. So if we move forward a couple of slides and just the practical steps to be taking. So I think now that the conventions are out, it's important to just assess the options that are out there for new RFR products and thinking about, well, what's feasible and suitable for your business. In terms of the euro, do read the consultation paper that comes out on fallbacks and look at the options that are proposed in there for different products and whether you agree with them or not. Also discuss with your lenders, well, what products are they actually intending to offer you? And in this respect, it's worth keeping an eye out on the RFR referencing facilities and also the approaches that are being taken in the market to legacy transition, because it's always good to keep an eye out on what your peers are doing and take some ideas from what they're doing. I also mentioned there's a need to think about what you're going to do or what the banks are going to do on multi-currency deals. Operational considerations are obviously very key, because clearly systems do need to be updated to refer to and cater for RFRs. So Please do talk to your system providers about whether they are implementing changes already to deal with Libor transition. And also just double check with them if you need to be on the latest version of the system in order to benefit from any RFR related upgrades. Finally, consider what language that you have in your documentation going forward. In respect of Euros, you might want to wait for the Euro Working Group recommendations. I would say that the trend overall is for stronger language to start being included into agreements, and I think that will filter into the European market. So speak to your lenders. You can speak to them about the new LMA language and whether this is something you should look at for your deals. But also consider your legacy book and how you're going to amend that and how that interacts with any related hedges. I think on a practical point, do bear in mind that the market is very busy on Libor transition and key resources. So, for example, bank and legal support will actually become more scarce the closer that we get to the end of next year. So there is a benefit in trying to get ahead of the issue. So turning to the final slide and some key messages, I think the overall message is actually a positive one in that there has been some really good progress that's been made over the last year. There is still more to do and some interim deadlines that are approaching, and I think those will help to move the markets along. And of course, developments in the international market will be no doubt watched very closely in the Euro area and will impact developments. And I think you'll be able to see that when the Euro Working Group consultation paper comes out. As I've mentioned a few times, a key development in the Euro area will be the publication of these fallback papers. So please do keep an eye out for it, and do contact Tarek or your local Treasury Association, particularly if you don't agree with anything that's in there, because I think it's so important for the borrower perspective to be heard in this process, because you're the ones that represent the real economy. So I know that was a lot of information to cover, but I do hope it was a useful overview of where things are at the moment. I have included my contact details on the very last slide. So do feel free to contact me at any time and ask me any questions. But thank you very much for listening. And I will hand back over to Tarek, because I know he's got some slides on the EU legislative proposal.
Thank you very much, Cam. And I'll just seamlessly transition over to that. And as Cam mentioned, there are some developments on the legislative side that are to do with sort of tough legacy in inverted commas. And I think it would just be useful to run through what is happening on the European side. And bearing in mind, this is, as Cam was mentioning, this is not meant to take away from active transitioning on Libor. It's meant to be a pure safety mechanism. So maybe for you to be aware of what is being done on the European level is, it's not finalized yet, but European legislators are reforming the European benchmarks regulation, which governs benchmarks and indices in the EU, to create a mechanism by which the European Commission can designate statutory fallback rates for Libor. So those would be rates that, by virtue of the law, replace any references to Libor in contracts that are still outstanding by a certain cutoff period. Now, this is in parallel to similar efforts that are underway in the US. So there is legislation going through the state of New York that would do something similar. And at the moment, the current state of the legislation would mean that on the European side, contracts that would be captured are contracts that are under the law of an EU member state and where the counterparties are European entities. There's also talk about extending the scope of that to contracts of EU entities that are governed by non-EU law, so long as it's in a jurisdiction that doesn't have actual fallbacks for Libor. So maybe just to outline how this would actually work. So the mechanism for the Commission relies on a number of pre-cessation triggers actually happening, and it's basically either the FCA or IBA benchmarks has to publicly declare the end of Libor or state publicly that it's no longer representative and doesn't measure the underlying market appropriately anymore, or if the FCA were to withdraw the authorization for Libor. Once that happens, the European Commission would then launch a procedure to designate a so-called complete rate package, is what they call it, from a sort of Libor jurisdiction or currency area that has a Libor rate. So basically, this would mean that they would look, if we take the example of the UK, for example, they would look towards the sterling risk-free rate working group and the recommendation that they have made of what the replacement benchmark for Libor should be, what the spread adjustment is and the methodology for calculating it, and what the conforming contractual changes that you need to make to your contracts to implement it are, and then designate that as the statutory fallback rate for all sterling Libor contracts that are governed by EU member state law. And then, of course, the implementing act from the EU would also specify from which date this would apply. This would likely be the day after the permanent cessation of Libor. So that is yet to be determined, but it's not going to be a random date throughout 2021. It would be sort of when Libor actually ceases to exist. And as I mentioned, non-EU contracts would probably also fall under the statutory fallback, provided they are held by EU counterparties and provided the third country jurisdiction doesn't actually have any fallbacks. Now, there are some important aspects to bear in mind to this. It is relevant for, at least on the European side, they don't make the distinction between tough legacy or non-tough legacy. The only criterion that is relevant is that you still have a contract that is open on a certain day, as in on the cutoff date, that references Libor. It's any and all contract. But it's important to point out that the use of the statutory fallback is completely voluntary. So contractual counterparties can always opt out of using it, but it is available for use if so desired. And it's also available for a number of constellations where there might be issues with transitioning contracts, either because counterparties don't agree, because the fallback language that is in the contracts is suboptimal because it refers back to Libor and would would fall back to a sort of fixed date Libor fixing. And then for all of those situations, the statutory rate would be available as a safe harbor for then contractual counterparties to opt into. But it's not going to be forced on anyone. It's meant as a pure safety mechanism to capture anything that hasn't been transitioned at the point of the cutoff period. In terms of just when this can be expected to be finalized, so as I mentioned, this is currently still going through the legislative process in the EU, the creation of this mechanism. I would expect that to be finalized by the end of the year. And then, of course, the actual use by the Commission of the designation mechanism relies on when the cessation triggers happen for Libor. So when the FCA actually publicly states that it's no longer representative and doesn't measure the underlying market anymore, then the European Commission can go ahead and use its designation mechanism to then say, okay, for sterling Libor, this is the replacement. For US dollar Libor, this is the replacement. For Swiss franc Libor, etc. So that happen over the course of next year. But of course, in the meantime, the stakeholders are meant to be proceeding with active transition, as Cam has just run through on her slides. So maybe that's just so much on the legislative side from a European perspective. And I'll leave it at that. And if people have questions, and I'll stop the screen sharing, you can type them into the chat box, or you can raise your hand and I can unmute you if you would like to ask a question in person. Otherwise, I hope this was informative for you, and thank you very much for listening. Maybe I'll just give it a couple of seconds to see if anyone has any questions. Yes. We will be circulating the presentations afterwards, together with all the links and references that Cam was alluding to. So you'll get that within the next couple of days. And also, as was stated in the registration email, the webinar was recorded, so you can watch it back at your leisure at another time once it's been uploaded to our website. Cam, maybe this one is for you. I think you have to unmute yourself.
Sorry, did the classic mistake. So when we'll publish the rate switch agreement with observation shift, so hopefully next week. So yeah, I've got the revised version. We're just looking through the commentary. So yeah, hopefully in the next week that will be put out, and we'll be releasing a webinar on those as well. There's a question on use of tenors in the spread adjustment. Yeah, so they are based per tenor, because the spread adjustment will be different depending on the tenor. So the way that it's calculated is, say, 1 month sterling LIBOR is compared to 1 month compounded SONIA, and then the same for 3 months, 6 months, and the same for US dollar LIBOR compared to the compounded SOFR. So there are spread adjustments per tenor that are available. And as I mentioned, I'll send Tarek the link to where you can find the published spread adjustments. On the ISDA protocol, I actually have no view on that, because again, I think it's going to be up for parties to analyse. As I mentioned, I think it's a super useful tool in order to amend a number of contracts, but it's just obviously checking whether that's actually right for all the underlying cash products that you have, where you've got hedging derivatives. So I think it's one that you'd need to analyse and just double check that the protocol actually does work for you and works for all of the contracts that you have.
Thank you.
Oh, I can't see the rest of this question. Oh, yeah, sure. So I can send the ARC, the link to the ARC hardwired fallback language. I'll just make a note of that. But yeah, I'll include that in the list of links. There's also one for bilateral, so I can send that along as well if that's of interest.
All right. I'll just give it another couple of seconds for any more questions to trickle in. Otherwise, we've actually kept it very well on time. Guillermo, can you unmute yourself?
Yes, hello. Thank you very much for the presentation. Very, very interesting. Just one quick one. What do you think LIBOR is going to remain, or is it going to disappear?
Yeah, I mean, I really don't know the answer to that question. It's an interesting one, right? Because I think ultimately it's sort of a question of, can ICE keep it going with the panel banks? Because I think that's the point that the FCA made, that they stated that they're no longer going to, require the panel banks or tell the panel banks, coerce them, for example, to submit to Libor. So they've got an agreement in place to say they'll carry on submitting until the end of 2021. Whether they carry on submitting after that, I really don't know. And I think it will be interesting to see, well, how does that interact with obviously the tough legacy proposals that I mentioned? Because if the FCA then decides, well, actually, we're going to make ICE change the methodology, well, then Libor will continue, but it will be a modified Libor. So, I think Libor by name will continue, but whether that is on the basis of panel bank polls or it's based on the modified Libor that the FCA dictate, that's going to be the question.
I think there's one more question from Meta.
On the use of the ARC. I actually don't know what the ARC hedged approach is, actually. So I'd have to look into that and come back to you on that question. Yeah, and I think again, I mean, I'm not a derivatives expert, so you'd have to, for people who are more familiar with that, I think it's worth looking at as I mentioned, ISDA has the bilateral templates. So you could, for example, in theory, have the protocol, but then bilaterally amend the effect of the protocol for just certain transactions. Now, whether you're able to define them by a class of contracts as opposed to, having to show each individual contract, I don't know. So that's something that I think you'd have to look at with your legal advisors, because I'm really not a derivatives expert in how the protocol and the bilateral amendment works. So I think there are ways that you can look at how to make that easier. I mean, obviously, if you're moving to the same rate in your underlying cash product, then great. So I think, if your hedge product is actually moving to compounded in arrears with a 5-day look back, and ISDA are going to be producing something which allows you to use that, then, fantastic. It makes it easier. I think the big thing is if you're then using a forward-looking term rate, for example, or something different to the fundamental approach that ISDA are proposing. Okay.
Okay, let's take the final question and then we can wrap up.
The USD RFR based on, I'm not sure I quite understand the question. So there are conversations. Obviously, you might have seen ICE came out with a bank yield index, which is basically compounded SOFR plus an adjustment spread. I don't know where things are on that at the moment. So I think ICE is certainly looking at that, but I don't think it's something that the ARC is looking at, because they've put out their compounded SOFR, and then so I think that's probably what the question is getting at. But as I say, those discussions I think are still very much ongoing in the US market, and there haven't been any final decisions or sort of, I think they're not going to make any final recommendations on it. It's going to be left to market participants to decide. So I think it's watch this space of where does ICE end up or other providers.
And then it's also just I think those rates plus then any spread adjustments would then also be what for any statutory fallbacks would then be imported as the statutory fallback rate. So just bear in mind for that safety mechanism that we talked about. All right. Thank you very much, Cam, and thank you to all of you for taking the time out of your busy schedule to listen in on this important topic. As said, we will share the material in the coming days, as well as the resources that Cam was talking about. And as soon as it's available, we'll also let you know when the recording has been uploaded to the website, so you can watch back the webinar when you like to. Thank you very much, and have a lovely afternoon and a lovely rest of the week, everyone. Bye-bye.
Thanks.